the rule of thumb when you're trading momentum trades is you actually have to trade them, in my opinion, with a negative risk-reward strategy. It's just a question of how and how long and how wide and how deep a target you want to set that I think creates the formula. So I'm showing you my very short-term formula. The reason I like to trade it in a very, very short formula, yes, all pairs are 515. Canal is asking me, is all pairs are 515? Yes, I trade all pairs 515, and I'll show you this exact same structure in euro dollar as well. So one of the reasons is, yes, I'm only making 5 pips, but on the other hand, I'm also risking only 15 pips. So let's say if I'm trading one standard lot, it's only $150 loss. So I'm capitaining my loss. And of course, you have to understand that losses are not guaranteed. You could get slipped by your broker. Stops are not guaranteed. So this is just simply theoretical. But in theory, presumably, I have a relatively capitated risk, and I have a very, very short-term target, and I'm shooting for 80% or better. So there's a lot of things that have to go right in order for the strategy to work, but that is what I'm operating on. And if you're using what we call my short news strategy, 10-minute time frame with a 5-target 515, this particular case that would have worked, of course, past performance not indicative of future results. But there's another variation. There's another variation that some other people trade where they extend the period. So the period, instead of 5 minutes after the news event, goes all the way out to 40 to 50 minutes after the news event, which is 45, right? This would be 45. And in that case, the low here becomes, I think, like 95, right? And so the box is bigger. The box is 43 to the upside, 95 to the downside, right? And in this case, you can also trade it with a lot of different variations. You can trade it with a 8 target and a 25 stop. So you'd be short 95. The stop is 120. The target would be 90.87. As you can see, 90.87. Let me just pop up the window. 90.87 is somewhere around here, around 5-6 minutes after the event triggers. Sorry, the event triggers like where? Around 9:30. So about 15 minutes after your trade triggers, 87, 86 comes into view, and the +8 gets done. Another way of trading this, and that will serve the third and following flavor for those that want to maybe have more room and more try to go for more pippage, is try to go for 15 pips. So here you'd be short 95, you're targeting 80, and your stop is 50. You're keeping the proportionality the same. In other words, 515, 825, 1550. The proportionality is essentially always around 3 to 1. And the reason why is because there's just no free lunch in the market. Boyke says this makes your broker rich. I utterly disagree. Because this has nothing to do with how I'm trading. First of all, it all depends on what kind of a broker you're trading. You could be trading with a broker on very, very tight spreads. You could be trading Pernex. You could be trading a million other different things. I think this is an incredibly idiotic way of looking at day trading. Day trading, by definition, is going to be very, very transactionally active. That's absolutely true. You're going to generate a huge amount of transactions. But at the same time, the whole flip side of day trading is that you're using very, very tight stops. So, for example, in my structure, I'm going to be minus 15. If I have 2 trades, maybe I'm minus 30. If you're using positional trades, you're going to be minus 300. You're going to be minus 500 on a single trade. Which trade generates more risk? Which trade generates potentially more losses, Boyke? So my point is that you have to understand what each strategy does. You have to understand that, yes, this is a highly transactional strategy that it requires a lot of trades, but at the same time, it also capitates a lot of losses. And that's why it's comparing apples to oranges. If you're positionally trading, you're trading with 200-300-point stops. In my universe, a 200-point stop, assuming I don't get slipped, but of course, these are all theoretical. We're having a theoretical discussion here. So, you need to understand that in real life, you could have slippage, you could have bad execution. All those things come into play. But on a theoretical basis, if you have a 300-point stop on a positional trade, that's 20. It's equivalent to 20 stops on my trades. So I'd have to have 20 negative stops again, on a theoretical basis, I could have one bad stop, and of course, it slip 300 points. That's just life. That's markets. But in a theoretical basis, you could have 20 stops in my environment, whereas in your environment, it's only one stop. So you need to understand what it is that you're doing and why you're doing it, and understand whether that makes sense for you or not makes sense for you. And it's actually the other question that is being asked here is it scalping? It is not scalping. Scalping is defined in trading as buying on the bid, selling on the ask. That is an activity that is, I think, impossible for retail traders to do. And even if they could do it, it's just fruitless. You're trading against very, very powerful, very active, very fast algorithms, very fast computers. I really, as you can see, this strategy takes generally sometimes 5, 15, sometimes a couple of hours to develop, right? And I think that's the only timeline that a retail trader could survive on a day trading basis, where the dependency of your execution does not depend on a microsecond or even a second, or even 10 seconds. In other words, you could take 10, 15 seconds to execute and still have the ability to stay with a strategy. I think that's the only time environment that a retail trader could have a general sense of competition. If you're going on any kind of a shorter time frame, you're competing against machines much more powerful, with much greater processing power and much more intelligence behind them than this is what I would call short-term day trading. This is not scalping. So it's a sweet spot between longer-term positions and longer than just simply, in and out trading that computers do. So where was I? As I was saying, there's basically 3 types of flavors here: 515, 815, 1520. But in all of them, you are trading with very deep negative risk reward strategies. Now, there's another flavor of this that some other people trade, and I think it's actually a very valid flavor of the strategy. It's just that I personally don't trade it, where your expectancy ratio, your success rate is certainly going to be lower, and that's a structure where you trade for 15-point target and a 25-point stop. Now, for example, in this example today, this actually would have worked. You would have taken a short at 99.95. Your target would have been 80. 80 was hit. Actually, 78 bid was hit. So 80 would have been done with a 25 stop. And in this particular example today, which is past performance, not indicative of future results, which is just a single example, and of course, no guarantee that it could be repeated, it actually would have worked. But by definition, and this is what I think is very important when anybody who trades on a day trading basis needs to understand, there is a payoff between risk and reward. Maybe somebody can show me a strategy where you can risk 5 points, make 15 points, and be more than 50% accurate. If you can do that, more power to you. I'd love to be able to copy your strategy. But so far, I've never been able to find a situation where you can risk a little, try to go for a lot, and have a high expectancy rate. There is a natural payoff between how much you want to go for, how much you risk, and your accuracy rate. The higher the accuracy rate, generally the worse your risk reward payoff must be. To me, that just almost seems like a function of the market, because otherwise everybody would be able to take advantage of the market, and everybody would just risk very little, go for a lot, and be highly accurate. And then I think the markets would of course wouldn't be markets, because they wouldn't be so competitive. Markets are very competitive. They don't allow you to have your cake and eat it too. You have to make a decision up front. What am I going to do? Am I going to risk a lot? Am I going to risk a little? Am I going to be highly accurate? Am I going to be highly inaccurate? What am I comfortable with? What's the best for me psychologically, financially, mentally, and every other way, personality-wise? So Kanyu seems to agree with me very vociferously. So I mean, that's basically my key point of today's webinar, is that yes, you can certainly day trade, but you need to understand the risks, the rewards, the perils associated with that, and be completely comfortable up front. You have to accept the fact that there will, that, you know, for example, in this particular strategy, I could be right 3 times in a row, and then the 4th time I'm wrong, and the 4th time, just the 1 time I'm wrong, is going to wipe out all the profits of my 3 times.